Most investments carry risk, but there's one that is all upside. The only risk-free investment is an investment in yourself. The Globe and Mail is the largest business newsroom in Canada, interpreting and unpacking macroeconomics, housing, policy decisions, and world events. Enjoy a comprehensive suite of business newsletters, breaking news, and market updates straight to your inbox. As a subscriber to the Globe and Mail, you'll get access to investor tools like advanced charting, portfolio with the Wealth Scope report card, providing an independent 6-factor review of your portfolio, and stock screener to help you find the right investments. The Globe and Mail is offering a special digital subscription rate just for Loonie Hour listeners. For a limited time, get access for $75 a year for your first year. For more details, visit globeandmail.com/podcast.
Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 73. As always, joined by the three amigos, barely. We got Rich Diaz of Acorn Macro Consulting and Keith Dicker of IceCap Asset Management. Keith's at the airport right now. He has to leave us in about half an hour, so a short segment for Keith. He's jumping on a plane to Frankfurt. And Rich, I don't even know where the hell you are these days.
I'm in France, where we are committed to the Loonie Hour and providing content to everyone, no matter what time or day or hour or country. I'm on yet another ski vacation because why not? YOLO, as they say. And I had to skip out on a fondue dinner to come and chat with you guys and the rest of our listeners. So
that's dedication right there. It sounds like you got another bout of COVID after your 6th booster there. What's going on?
I've had 10 boosters, and yes, indeed, I have. I've had a bit of bout of COVID, but really, I've just been skiing all day, so that's why my nose is red and my throat's scratchy. But it's been good here. But anyway, Keith's the one we gotta pick Keith's brain on what's going on in Toronto and what's going on with JT and the rest of the world.
Yeah, Keith, we're gonna have to maximize your boomer wisdom. By the way, guys, we do have a fine on this show, $100 for any time a mic has been forgotten. So Keith is without his mic, so he's got the Apple AirPods in. So if the quality stinks, you know who to direct your anger towards.
Yeah, it's a bit of a 1% problem. But Rich, what's going on with the romance there in like France, the country I love?
No, not much. Apparently they're in love with meat and cheese over here. So I've been eating too much of that, but it's been a beautiful sunny day. Just been hanging out and haven't met anybody on the slopes this time. So we're keeping it clean.
Jeez, what a disappointment.
Let's go. So we had bank earnings. We had bank earnings over the last couple of days.
Yeah.
That's one thing. What else do we have lined up?
Yeah, we got the Canadian housing. We got some Canadian housing data for the month of February in Vancouver and Toronto. You got your bank earnings. You've got flat zero, big donut on the board for Canada's fourth quarter GDP, and then hotter than expected inflation in the Eurozone, which Keith, I'm sure you flagged as well. So we'll get into all of that in this episode here. But to start things off, looking in the GTA, home sales down 51% year over year, second lowest in 20 years. Number of homes that were listed for sale down 42%, the lowest level in 20 years. Very, very similar story where I am here in Vancouver. We had sales down about 47%. It muddled along. If you look at it from a historical basis, weren't as bad as 2019 or 2013. So, but overall, pretty weak month for sales here in Vancouver. The big sort of shocker, which has been, we've been chatting about it on the show now for several months, is new listings in this market came in at a 26-year low. 26-year low for new listings in the month of February. So again, I don't know, we've all been trying to predict the housing market. There's certainly a lot of commentators on the YouTube show and on Twitter, and I don't think anybody, as far as I can recall, had 26-year lows on their bingo sheet there. So it's interesting. It's really, really weird. And obviously, hey, hard to have sales, hard to have turnover if you have nothing to sell. So that's
what's
kind of
going on
the
with mortgage.
story.
Oh, sorry. What's going on with mortgage? Which mortgage rates in Canada? How have they moved?
Yeah, they're starting to creep up. I mean, I watched the Canada 5-year bond. I mean, it may as well be my homepage now. The Canada 5-year bonds ticked up to about, back up to about 3.7 today. Or 2 points. Yeah. Anyways, it's
Still
it's back.
So it's still inverted. I mean, you still live in that inversion world.
Yeah, it ticked up into just over 3.6.5, 3.7. So you're getting back to the highs that we saw at the end of 2022. So in terms of your 5-year fixed rate mortgages, those are creeping back up. You'll see some more hikes probably in the next couple of weeks from some of these big banks. So, you know, the optimism around 4% mortgages was very short lived. And I think, you know, heading into the spring market here, mortgage rates are going to be back up on the climb. Keith?
Well, I'm sensing the optimism up over here as well. But one thing that's pretty cool where I am, it looks like I'm like a weather person, doesn't it, on the YouTube channel? I'll point this way. There's an ice cap coming just to drop me off.
He's got a glass of wine. Vacation Keith. Let's go.
Yeah, there we go. You know, I think though you know, everything here is all connected. Oh, by the way, this is like a live Loonie Hour event. There's about 200 people here in the Montreal, Air Canada Maple Leaf Lounge. Is that right, Rich? Is that what you'd call it?
Tell us about the Wi-Fi in the Maple Leaf Lounge and how another oligopoly is shafting Canadians.
Yeah, and right now everyone is listening to, you know, Boomer here. But let's jump over to the banks, because, you know, we had, you know, the mortgage data just came out. Rich, then you can jump into the GDP data. Everything is tied together. But yeah, you know, we had the Canadian banks come up the last 3 days, and you know, the headline numbers were okay. Everyone, they always beat, of course, that's what they do. But the big number everyone is looking at, like, nobody cares about capital markets and trading, because, you know, they can make that for what it is. But the loan loss provisioning, everyone ramped it up higher again, because they had to, of course. They are still at levels of what they were provisioning for the last decade before the pandemic hit. And obviously they've written more loans since then, of course. So they're still in trouble of, you know, being significantly exposed to this hard landing that we may or may not get. We believe we're still going to get it. We think the probability of it happening is still quite high. And you know, so during the week, some of the bank stocks had they weren't great days, especially, you know, RBC. I think they were trading down 3 to 5% yesterday, I think, on under earnings data. And today's Thursday, by the way. So then you were talking about Wednesday. That's a bingo card, right?
There's another one.
Maybe.
Indeed.
It's maybe. And so what was kind of funny this week on Twitter, I even suggested that Canadian banks might, you know, if they ever cut their dividend, you know, God forbid, you know, Canada would just roll over. And it's just interesting that even people who are pessimistic about the economy and the way things are moving, like, they were even attacking the statement. You know, you can never say anything ill towards the Canadian banks. So, but, you know, just to summarize with the bank's earnings, this is moving, like, they're nervous. They're ramping up the provisioning. They're trying to be as positive as possible as they can with everything else on the earnings that come out. But if we roll over, you know, you're going to see some pretty big credit headaches coming up for those guys.
Couple notes on that. Yeah, Scotia, I think, had one of the big, I guess, misses. Certainly a company that, you know, I can tell you anecdotally, was pretty heavy on the residential investment side. You know, we had a lot of they definitely catered to that market. And then certainly, you know, if you think about investors that buy real estate, you know, a lot of them will tend to float their debt on variable rate mortgages. So I think you can certainly see that in the price movement of that stock there at Scotia Bank. And you know, their CEO basically came out and said, listen, we're going to have to ramp down sort of mortgage originations and try to focus on growing our deposit growth. So I found that kind of interesting. There's always been a lot of shakeup and turnover there at Scotia. I think they mentioned that they had, like, I think if you look at Scotia's residential book, about 36%, I believe, 36% of their book is variable rate mortgages. So they got certainly a lot of exposure. You know, that's interesting. But
you know, and then they have the emerging markets land as well. They can get hit with a double whammy. Oh, by the way, Rich, I was thinking of you about 20 minutes ago. Do you know why?
Because I was late to the podcast recording.
No, I was at the salad bar here, and guess what?
Ah, very good.
I made no friends, zero friends at the
Yeah,
salad
well, you
bar.
don't make friends at salad, as thankfully our loyal YouTube commentators have hopefully educated you in the ways of the Simpsons.
However,
Keith there for a second.
Yeah. However, a good friend, Steve M, out in Vancouver, he pointed out to me that you don't win friends with salad.
Oh my goodness, that's
Yeah,
right.
That's tough, Rich. That's tough.
Wow. So, just touching on the wrapping up the Canadian bank side. I don't know if you guys noticed this, but I found it was kind of like an interesting tidbit that was circulating there on the Twitter spheres. But TD, so just going through some of these bank earnings here, looking at some of the numbers, it was noted that TD and CIBC have just over 25% of the residential mortgage book with amortizations greater than 35 years. So last year, that number was essentially zero. And so now 25% of their mortgages have amortizations greater than 35 years. So essentially what that's telling you is these people that were on these static variable fixed payment mortgages, basically their amortization, which may have originally been, say, a 30-year am, is essentially being pushed out to 35, 40. I mean, we've seen some that are 45-year amortizations, right? Because basically no principal is being paid off on these mortgages.
So that reminds me of the European crisis. I mean, there are several, but the one between 2012 and 2016, at the time I was working for a company and I was working as a sort of the number two for the European investment strategy. And a term was coined, which I think is apt for the Canadian mortgage market, which is extend and pretend, or is it pretend and extend? I can't remember which way it is, but it's amazing. And what they did at the time was a lot of the Greek debt that was, 10-year bonds or 20-year bonds or whatever, it was the maturity was basically pushed out. I mean, I want to say to infinity, but that's just being mean. It was pushed out to 30 and 40 years, basically. So the same notional value was owed, except the duration of that bond was effectively pushed out further and further and further out. And it's sort of a similar type of things happening in the Canadian housing market, as you've so eloquently pointed out, which is, instead of having a 25-year loan or a 30-year loan, what they do in the US, you've got 35 and 40 and my goodness, we'll probably hit 50 eventually. I mean, it just tells you that, somebody somewhere is going to have to take a write down, or just Canadians are going to be in hawk to these banks for a very, very long time. And their disposable income and maybe the price or the value of these assets is going to have to come down. So, somewhere someone's going to pay. And it's just, I guess we've discussed this before. Now it's just a negotiation, sort of who's gonna feel it. But extend and pretend. Did I get that right, Keith?
Extend and pretend.
Yeah, you were pretty good. It's extend and pretend. But I'm surprised because you're usually very accurate with your numbers and in your data, Rich. But you're a little off with this one. But the European crisis, it started about 1000 BC. And it'll continue until 3000 BC. So it's a bit of a wide berth you got going on there.
Yeah.
Keith, do you have any further comments on that? Because I've got some commentary on just some anecdotal stories as well.
On Canadian or European?
Just on the mortgage side there.
No, nothing more than just I really think it's at the maximum point of pain right now until something breaks. Do you know what I mean? So again, like overnight rates are not going to go any higher. The yield curve, even though the long end has risen, a bit over the last couple of weeks, and the banks love that, by the way, because richer net interest margins you like to follow, they prefer a steep curve, especially on the front end. But if we do break coming up, then it'll get worse. But if we continue to plot along now, I think they'll work out well, which is not our base case, by the way.
Yeah, I'm just noticing, like, anecdotally, like a lot of the conversations I have, it's basically people aren't really doing anything with their fixed payment variables, like they're like these people that now have, 40, 45, whatever amortizations, everyone's just kind of just like sort of sucking it up. They're paying like the new increases, but they're not like I think a lot of people aren't actually like restructuring the debt. They're not like not in bulk anyways, like converting to fixed mortgages or, accelerating payments to pay off their mortgage faster and get principal pay down. Like it seems to be kind of just like, okay, let's just leave it. It is what it is. Hope that rates go back down, sometime next year. And people are more or less just kind of, just leaving. I had a call from a guy this week actually, and it was just interesting. He had a mortgage with TD. So he had a variable mortgage with TD. And he says, I'm thinking about potentially selling my home. What do you think? And, he bought the house kind of near the peak so that he wasn't really able to sell it without incurring a loss. He goes, well, I don't really want to incur a loss, but, it's okay. It's kind of just like breaking even, cash flowing a little bit because my variable rate mortgage has not increased. The payment has not gone up. I said, oh, that's interesting. Most of the times you're seeing the payments are at least going up a little bit. And he goes, no, what they're doing is because I had this loan to value, right? He had a 70% loan to value when he initially entered into the contract with the bank. And so what they're doing is they're basically doing like a negative amortization. They're essentially adding to the balance of the of the mortgage. So he says, every month they add on, $700 or $800 a month to the balance of the mortgage. And so they'll continue to do that until they hit basically an 80% loan to value threshold, at which point TD says, okay, you're done. We now need to convert you to, a fixed mortgage, or you gotta restructure this somehow. So I found that very, very fascinating because it to Rich's point, it is kind of like, extend and pretend basically. And so I suppose that could work so long as rates come down meaningfully or the housing market bounces back in a year or two. Or
well, I don't think. Oh well, I'll go first, Rich. Overnight rates are not coming down for a while, guys. Everyone might think they're going to rate, they're going to stop and then start cutting them in a few months. The only way that would happen if domestically we have a challenge and the rest of the world doesn't. If everyone's having a challenge, they'll need to save a dollar. It's one thing to save the housing market or the bond market, but they have to protect the dollar as well. So I think we're headed for again, if we fall off from here, it's going to be a tough one coming up. What do you think, Rich?
Well, no, that's exactly what I wanted to say, which is that strategy I think only works if you think that interest rates are going to come off shortly. I think eventually, people will wise up to the fact that they're now paying an incredible amount of interest and a very little bit of capital. And I, like I said, that only sort of, as I agree with you, Keith, that I'm more aggressive. I'm a little bit more hawkish on like what will happen to the overnight rate. I think we still see some hikes before the end of the summer, surely, as we discussed a couple of weeks ago. But you're right. The only way that sort of works, that strategy.
Wait. Did you say Shirley?
Even with a horrible Wi-Fi, you still make terrible dad jokes. So good for you. Your kids must be very proud.
He's consistent, at least.
Yeah, that's right. Should we get into the GDP numbers at least a little bit?
Well, I think that kind of goes hand in hand with kind of a weird housing market, and certainly the future direction of interest rates. We've had stickier than expected inflation, but the worse than expected GDP print. Rich, maybe walk us through that.
Yeah, sure. So basically, the real gross domestic product was nearly unchanged in the fourth quarter. And if you look at the final domestic demand, which is expenditures of consumption, gross fixed capital formation or investment, that was up basically very slightly at 0.3 for the fourth quarter. So that's the first, flat after 5 consecutive quarters of increase. That's like the first sort of quarter of either decline or no increase. And it just speaks to more weakness. I think we've discussed this before, which is housing investment is going to be a significant drag. And again, and why is that so? It's because we had, gross fixed capital formation can be broken up into different parts, non-residential, which is, equipment and structures and intellectual property, and research and development, et cetera. And then there's the residential bit. And we discussed, I think maybe this time last year, that residential spending as a percent of GDP was up in the 8, 9, 10% range, which is the number we saw in when you looked at Ireland's housing bubble or Spain's housing bubble and the US housing bubble. And now what we argued was, as that number starts to drop off, which is the residential gross fixed capital formation starts to come off, just because that's sort of inevitability of higher rates and et cetera, that it's going to be a real big drag on GDP. And lo and behold, that's sort of what we're seeing. So housing investment fell 2.3% in the fourth quarter, which is the third consecutive quarterly decrease. If it sounds like I'm reading this, it's because I am. And of course, this was new construction, renovations, and then something called ownership transfer cost, which is equivalent to sort of a goodwill number, but for residential.
Ownership transfer cost is essentially like realtor commissions. Yeah,
so it's like sort of a goodwill. It's kind of a fudge. It's like sort of I don't want to say added value, but it's sort of that sort of margin, and that's just collapsing. But however you slice it, I mean, you're just getting a huge drag from housing investment. On the positive note, business investment, non-residential, which is the sort of other part, rose, and so did household spending. But what's, again, just to wrap this little segment up, which is to say, remember how many people are coming to Canada each quarter, and GDP was flat. So what we're seeing is now that we're starting to see the real GDP per capita is really starting to, if this isn't, I can't remember, I'll have to go and check the chart and I'll share it in the Loonie Hour Substack. But if this is not I think this is at least the first, if not second quarter now that you have a decline in per capita GDP growth, which is not a good sign.
Keith, Steve? What do you think?
I mean, we saw the Q4 numbers come out, and they're pretty weakish. That's where we're going. The January number looked okay, but that's because the December number was revised lower. So this is where we're going. Like, we always talk about the path where we're headed, and path where we're headed, it continues to look like we're headed for an economic slowdown. Inflation's going to remain sticky. Is that a Rich, 3-4%? Who knows right now? I don't think it'll go much lower, truthfully. And at the same time, we could have, the high in equities rolled off in January. Now we're starting to go lower again. So I continue to suspect we're going to get this really great opportunity, to put risk on. So for people who were, holding their own last year, that's awesome. And we're seeing the same thing so far this year for us and our portfolios. Like January and February, so positive. Just like watching paint dry, and it keeps looking good after it dries. And so we're going that way. But again, everyone, we have to be concerned that the economy does roll over, because then that's when you get job losses, and that's Keith, where we're not yet.
What I'm most curious, I want your feedback on, is it was interesting because, you had this zero flat reading for Q4 GDP. And the BOC, the Bank of Canada there, had forecasted in their monetary policy report most recently that they had Q4 GDP coming in at 1.3%. So they forecasted 1.3 and it came in at 0. I'm kind of curious your thoughts on maybe how they might interpret that. Obviously, they've got an inflation mandate, but certainly that's a huge disappointment. I mean, I don't know if they'd be happy because they obviously need to slow the economy, but that's a pretty big miss.
Well, I think that's quite obvious that they expect the number will get revised higher in their minds. But again, I think now they're very concerned that they hike rates so aggressively, so quickly. And that's the way it works with monetary policy. You don't know the effect until 2-3 quarters afterwards on what's going to happen. But again, we keep going back to, this is not a Canadian problem. It's the same, the Europeans, the same problem, the Americans, the EM countries in South America and Asia. Like, for example, the South Korean PMI number this morning, I think, Rich, like it just...
Industrial production.
Use industrial production, but it's...
Yeah. Again, like, you're seeing just little hints that things are not getting better. They're rolling over if you're looking for it. So maybe we're looking in the wrong weeds, but this looks like it. I think in hindsight, history is going to be unkind to the central bankers, which is rarely happens, right, Rich? But
Yep.
I think it's going to show that, they were, obviously they missed everything in 2020, and then they got too aggressive and they kept it going too late. But remember, the key here is it's not the Canadians or the Koreans or the Europeans or anything like that. It's the Americans. What are they going to do? And the Americans continue to suggest they're going to stay hawkish for longer and higher. And that's the key thing. That's just going to suck capital out of the world, suck it out of Vancouver, suck it out of Lyon over in France, and even here in beautiful, dreary Montreal.
So Keith, you've got the Fed revising, or the markets, I should say, are now expecting the Fed funds rate to move higher than the Fed is actually predicting. I think the market's now pricing in 3 more hikes from the Fed. So I think 5.
Oh, no, that's right.
75.
5.5. Yes. No. Up another 75.
Yeah, no, up another 75. So again, let's just say hypothetically, let's just say that happens. I guess how weak can we potentially prepare or plan for to see the Canadian dollar? I mean, clearly the BOC's kind of stuck. They're trying to weigh the Canadian housing market and the highly levered consumer here, private sector. And then you've got the Fed, which is just going to power through. I mean, they're certainly in better shape than Canada. And so, I mean, it's just seems like it's going to be tough times for the Canadian dollar.
So the best case scenario is that the Fed is wrong and they don't have to hike as much, or they still hike, but with dovish hikes tone underneath it. And then the Canadian dollar will flop around between, 68 and 78, something like that. The other story is that the Fed continues to remain hawkish, because remember, they have the late 70s, early 80s scare. And the scare there happened twice, in that they raised rates aggressively to stop inflation, and then they stopped too early, and then cut rates, and then they had to raise it again. So they don't want that experience. So what will likely happen, the Fed will remain hawkish. Everyone else has already turned less hawkish or dovish. And, again, so Canadian dollar world, you can see, where are we now today? 74, 70, 73-ish, I think, in that range. And I thought it could easily hit in the 60s, was it low 60s, mid, who knows? But if there's a crisis, it'll get hit hard, just as everyone else.
Rich, you got any comments on that?
Yeah, I just think, just one thing on the Canada thing. I think, often it's like a balance, right? Because I think one of the counter arguments that people might say was like, well, the Canadian PMI rose back up to 52.6. We're seeing that's, PMIs out of Europe that have improved. China, I don't know if we've talked about that. Oh, sorry, I got that number wrong, but the Canadian, PMI is back above 50. Excuse me. Sorry, I screwed that up. I can tell you the exact number right now. It's the market PMI is 52.4, excuse me. And so, that's after, spending the fourth quarter below 50, which is in the contractionary zone. So people say, well, Rich, GDP data is backward looking. It was Q4. We're actually seeing decent numbers in employment. We're seeing decent numbers out of PMIs. We're seeing, Europe doing okay and the US is powering ahead. Why don't you guys have a sort of a more positive sort of forward looking view about Canadian economy, given what we all know, which is GDP is a backward looking indicator? And I think it's that residential piece that I think people just sort of don't get, which will, and then that's just a really huge drag given, the bubble that Canadian housing was in. But also I think what's important is the contributions from the other sectors have also really lagged. One thing we talked about is employment, and employment is often sort of as a lagging indicator. So that's another sort of important wrinkle. And what do you do when you're a business and you're very, very profitable? Well, you want to sort of expand your operations. You want to take on more employment. You want to take employees, you want to perhaps take more risk. Well, there's another part of the GDP sort of number. There's like expenditure approach, which is what we normally describe, which is investment, consumption, government spending, net exports. But then there's the income approach of GDP, which is sort of where profits, whether profits or compensation for employees, et cetera. And on that scale, gross operating surplus of financial corporations fell by nearly 7%. and profits in general for lots of the companies in Canada continue to, they're under a lot of pressure. And if companies are under pressure, what do? They stop hiring. And so, it's just important that those are the kind of that's why you have to sort of, when you look at the PMIs that are improving, you sort of have to be a little bit skeptical, because, that might just be sort of a short-term blip. And unless you get companies to, improve their margins, improve their sales, et cetera, they're not going to keep that hiring going. And then sort of that'll sort of feed into the rest of the economy. But that's the
I mean, the data could be noisy. Keith, you got to get rolling here.
Yeah, and there you go. Thank you. Yeah, I do have the jump here, but maybe one thing, guys, so you guys can continue with this conversation. There has to be good news. There has to be some bullish news out there. You know what I mean? Because right now, from a macro perspective, it doesn't look good, right? Everything is set up to experience something, yet that hasn't happened yet. So, I mean, the other side of the coin, and the way that we manage our portfolios, like we're never all in one camp or the other. We're a bit of a chicken middle here in some ways, and pay the fat tails. But we continue to go along this path. It's not awful. Maybe it doesn't go awful and it accelerates, but that's something to think about. So notice that what I'm doing, guys? I have to leave, so I'm leaving as the nice guy. And good news.
The gilded recession.
You guys either knock it down. Yeah.
Keith, as Keith flies first class to Frankfurt.
That's right. And his kids are in economy class. Don't forget that, right, Keith?
Kids are at the back of the bus.
Yeah, it's a funny. Here's a funny story for you. A few years ago, we were meeting my American friends up in Quebec City. He goes for ski weekend, and we're trying to connect with them. When are you guys getting there? And he said, "What airline you taking?" They said, "Well, the jet." And we're thinking, "Oh, WestJet. Okay, WestJet in the what flight number?" And our friend says, "No, it's the jet. It's the private jet." Like, oh, of course it is. They live in a different world than us. Meanwhile, like we're in, the old car driving out from Halifax. So
good
anyway,
friends to know.
They're lovely.
When are they flying us to the next Loonie Hour event?
Yeah, we need a few of those. Okay, guys, I got to jump. Lots of love to everyone, and I hope Rich explains the diffusion index for the next 20 minutes.
Safe travels, buddy.
Safe travels, Keith.
And then there were two.
And then there was two. Oh my goodness, how are we gonna do? We're like a tripod with only two legs. What are we gonna do, Steve? Should we just shit talk Keith and talk about how bad he is at organizing Wi-Fi and then microphones and stuff?
This is probably the third time he's forgot his mic. So at this point, I'm losing my patience. But maybe everybody in the YouTube comment section can hopefully let him know that. Rich, I wouldn't mind chatting on. I was hoping to get Keith's a quick opinion on this because I know how much he loves the Eurozone. But the big story today, of course, was the European Union EU inflation came in hotter than expected. So core inflation accelerated to a record 5.6%. That's core inflation. So consumer prices rose 8.5% year over year versus the estimated 8.3%. So German 2-year yields surged on the news. So now the highest since 2008. So just the Eurozone. I don't know. I mean, it continues to sort of defy gravity, but it kind of looks like a mess.
I mean, it isn't a mess and it isn't, right? A little bit of inflation is a good thing. I know people are going to fucking kill me for that, but I think if a little bit of inflation is a good thing. It's about whether or not inflation expectations get unanchored. So in Canada, we've discussed this. Inflation expectations have got unanchored. How do I know this? The Bank of Canada conducts a survey and they ask people what they think about inflation and where it's going and over what time period. And we know, because I've shared the chart many, many times, that the chart looks like a hockey stick. It's flat for ages and then goes to the moon and refuses to come off. I think in Europe, for a long, long time, inflation has been very, very low, very, very well behaved. So between 2000 and 2020, the average inflation, was at or below 2%, which is exactly sort of in their mandate. They'll probably try to take as much credit for that as they possibly can. Who knows? And what we're seeing now is we're seeing headline inflation is off its peak, right? Because, it's largely to do with the energy price spike that we saw. There's different items that I don't know if you mentioned this, but super core, which there's core, super core, headline, there's sort of all these central banks sort of make up different things that I guess push policy that they're trying to go through. And the question is this, has it become unanchored? Are people, is it becoming a problem yet for these economies? I mean, I don't think so yet. Keith's not going to like this, but he's not here to defend, to disagree, which is a little bit of inflation is good because you can deflate some of these debt burdens away. And we know that there's loads and loads of debt in Greece, in Italy, less so now in Spain, but France is a highly levered economy.
Good.
And
I say good for the debt loads, but maybe less good for the people.
Absolutely. So that's why, the Germans are starting to squawk. And that's why, I think that Christine Lagarde is saying, we're going to raise rates. And we know that the equivalent of the Fed funds rate expectations, or, that Canada has sort of these futures contract that sort of predict what the future interest rate path, those are starting to rise a lot. And so that's the world that we're in. We're in a world where the central banks are playing catch up. I mean, the ECB main policy rate is 2.5%. I mean, I think we're going to break sort of the all-time high of 3.75, which was struck in 2001, if you can believe it. And that's exactly what the markets are pricing in. So, I mean, I think it's a little bit unfair. Sort of, I'm quite critical, and Keith is too, of Europe. But this is partly an energy crisis, and I think as that sort of gets solved, I think you'll get a lot less pressure. But
does it get solved though? Like in the near term? I mean, a lot of indications suggest this war is going to continue for at least the next year or two minimum.
Yeah, and how can we tell? One way is to look at energy prices. So natural gas prices have definitely come off their highs from last summer, but they're still 5-6x what we know in the US, right? And I don't think it gets solved.
Warmer winter.
I don't know. I mean the winter was better than people expected. I'm in France right now. There's no snow. The conditions were absolutely horrible. I mean, it's beautiful and sunny, but I was promised a ski in and ski out hotel with Wi-Fi, and I got neither. I don't know. I think it's unfair to stress only the bad stuff, because there is some good things going on. We talk, for Europe, current account balance that's structurally positive is very, very important. It basically ensures that, negative Nancy's like Keith, who think the euro is going to zero, are going to be wrong. If Europe continues to export products and generate inflows of cash outside, you can sort of keep the game going. One way to do that is by having cheap energy, and and who knows how long that'll go on for. But that's something that's definitely improved. The sentiment in Europe has improved despite high inflation. Consumer confidence is low, but it's rebounded for sure. Business confidence, whether it's Germany, France, that's sort of improved. We would have expected real GDP growth to be negative in Germany by now. It's held up, not well, but it's okay. You look at the shortages of material in the automotive industry and construction, that's all sort of improving. I mean, I think it's just more of what Europe does extremely well, which is just muddle along.
It's interesting though, right? I mean, the Germans,
it's
just, this sort of stagflationary environment. And certainly the Germans are pretty sensitive to the scars of inflation. So yeah, I mean, how far do you think the ECB gets?
I don't know, man. I'm surprised that they're as aggressive as they have been. You remember they've only just come to terms with the fact that it's not transitory. I mean, there's some great people on YouTube and on Twitter are just fantastic, right? They collated all the times that Christine Lagarde was talking about the bump in inflation, and I think they're finally starting to get that it's not going away. I think what's also interesting is that there's in the past people have discussed sort of wage price inflation. If you have the way that you can sort of sustain higher inflation for longer is if you have decent nominal wage growth where people can sort of absorb those increases in prices. Well, guess what? I mean, negotiated prices, which is one of the ways that you calculate that for Europe, is starting to creep up higher and higher and do okay. Which means that people are feeling that they have pricing power and can demand higher wages from their employers. We'll see. I mean, it's a really, really tricky, I think it's really tricky business. And I think we can also not discount how important the fact that, Russia has tried to invade Ukraine, and that's putting a lot of pressure on whether it's supply chains, agricultural products, obviously natural gas and oil. And it's sort of maybe it's unfair to judge Europe by under normal circumstances, because they're basically fighting a war right now. And so I think we need to be a bit more kind, but maybe I'm just getting soft because I'm in the mountains and it's a beautiful sunny day.
Yeah. I mean, it's just not like this to me. I mean, here's your thoughts, but I mean, it feels like it's one of the most complicated markets to try to like figure out. Like, it's just, I just, you follow so many smart people online and everybody seems to think they've got the answer, but I've never seen so much disagreement on the outcome here, and you're getting all these different data points. And yeah, I think my biggest thing is just like volatility. I mean, you're going to continue to get a whipsawed from all these data points getting dropped every couple of weeks.
It's also about expectations, right? Because I think when natural gas prices were as high as they were, I think at one point they were like 20 times what you'd find. So natural gas prices, it depends on how you calculate them and what market you're looking at. But natural gas prices, I think over the summer, were something like 20 times what they were in the US. I think that was the absolute peak. And of course, in that scenario, your expectations for literally the collapse of the European industrial base, that's front of mind. That's like a realistic outcome. But now you're in a situation where it's only, I'm looking at the chart right now, we're at 5x so the way you calculate it is there's ICE, there's Europe Trading Hub, there's Tidal Transfer Facility out of Netherlands. These are different types of pricing and indices and markets for natural gas, and in the US it's Henry Hub. And right now Europe is 5 times more expensive for natural gas, which is one of the key inputs for energy, for heating, and for the industrial base in Europe. And so I think it's about expectations, which is at one point, literally, they thought, it was the collapse of the industrial base in Europe, to now going, well, maybe they can survive. And I think that's the first leg that we're sort of seeing. So when you look at the German ZEW or the PMIs or the expectations on what's going on with consumer confidence, et cetera, I think we're only starting to see the recalibration from it's the end of the world to maybe we can get through this. And so that's the part. I think and we need to sort of see the next leg of data and sort of how can companies and industries absorb this kind of outsized increase in energy prices. Maybe that's a sort of a cop out as far as an answer is concerned, but I still think we need to see what sort of the next leg, the summer, and what goes on.
Well, remember, there's no business case for exporting our Canadian natural gas to Europe.
God. Don't get me started on that.
I don't know if a nice little victory for you here. We were chatting about it in the group chat, but so the Vanguard CEO came out and recently abandoned his ESG investing alliance, saying, quote, he's not in the game of politics.
Yeah, I mean, this is inevitable. I think it's probably because they're just not making any money. I mean, that's what it was always about. That's what it is about. Financial innovation, as I've mentioned before on this podcast, should always be treated.
But Vanguard is not for profit.
Wait, what?
They're not?
Vanguard is a for-profit company for sure. Yeah. Vanguard is a massive company, but it's an ETF provider. Unless Vanguard Group is American registered investment, as a global asset manager, and it's one of the largest. I think.
They kick it all back though.
No, but they take their spread. Don't you forget it. They take their pound of flesh. They take their spread and they take their pound of flesh, and it's an extremely profitable company. if I'm not mistaken, they're one of the pioneers of the ETF exchange traded funds. And the gentleman who I think his name is John something, I can't remember now, but so he's a, he's a visionary, to be honest with you. And he's somebody that's worth looking up and learning about. But yeah, I mean, stepping back just a second, I mean, the reality is that ESG was always a scam. But more importantly, as companies realize that they cannot do it profitably, I think it'll just become less and less popular. But let's not harp on it too much. I wanted to talk about China if we can, just quickly.
Bloomberg says Vanguard is essentially a nonprofit. So.
Yeah, but so is the so there.
Take it as you will.
You're gonna get me in
Someone's
trouble.
making money.
Someone is making money. But if I'm wrong about that, I'm sorry. But
I could be wrong anyway. Someone will correct us.
Yeah. I wanted to talk about China quickly because I mean China is the largest economy on a purchasing power parity basis, and you can complain all you want, but the data out of China has been very strong, as sort of we should have expected, as the market priced in a couple of months ago, right? Remember, we saw sort of the CSI 300, the Shanghai Index, Hang Seng, and a bunch of these indices sort of snap back on the news that the economy was going to reopen, and the purchasing managers index, my favorite, the diffusion index, shot up to 52.6, which is okay.
Highest in 11 years.
Yeah, exactly. So you beat me to it. So I mean, you have to sort of just take that with a grain of salt, right? They went from like an absolute insane lockdown, not like a Mickey Mouse lockdown like in Canada, but like a proper crazy draconian lockdown.
I mean, let's not call it proper, but yeah, it's
you know what I mean though. But like, and so they're opening up, and that's an important lever as far as global growth expectations, its impact on commodities, consumers. I mean, luxury goods sales have done really, really well over this past earnings season. I mean, I can only imagine it's going to trickle into travel, et cetera, et cetera. So I think it's just really, really important that people recognize that that's happening.
Well, they're basically like a full year behind, right? So it's kind of like what happened to us post lockdowns, like as people sort of came out of that. It's like, well, you had this huge boom in travel and people going out to restaurants and beginning to socialize again. So obviously service inflation obviously ripped higher.
Yeah. I mean,
as goods rolled over.
That's exactly right. I mean, the problem is like you have to just be careful, right? With these diffusion indexes. I mean, I could just hear Keith laughing at us right now. But it's not just the manufacturing component. It was the non-manufacturing is also way up, which is services. And that's at 56.3. So that's a very, very good number. Remember, 50 above and below 50 is expansion and contraction. I mean, I think the other point is that you're right about them being a year behind, right? Keith often talks about risks being synchronized, and I would agree with that. But I think what we're seeing right now is the macro is unsynchronized. Is that a word? Where you have sort of the US sort of later cycle. You have the Europe sort of quasi in the middle due to war and other factors. And then you have China sort of right at the beginning, really, of this new sort of expansionary or mid-cycle phase. And remember,
it continues to muddle the whole picture. That's the reality. It's like you were kind of I don't know. Like I said, it just, to me, it seems like there's just so many data points and the markets are just moving all over the place. Like the only thing I think people should have confidence in is volatility.
Yeah, definitely. And the other thing that's really important is we're seeing the Fed tighten or continue to tighten, even though, let's say, most of it's already done. We're seeing the ECB. We just talked about that. They're going to raise rates. The BOC, the People's Bank of China, so the PBOC, is doing the opposite. They're providing liquidity. I mean, they haven't cut, the reserve requirement ratio or central bank rates in a while, but they have done. They're the only central bank in Asia of any consequence that's done so, and they're going to continue to provide liquidity. And we know that M2, so money supply, is the highest it's been in 5 years. Lending growth year on year has stopped falling, is now going up again. So there's, as you mentioned, there's conflicting sort of data points. The other thing about Europe is, in many ways, of course, maybe culturally it's tied to the US. From a military and political standpoint, it's much more closely aligned with the West. But make no mistake, the machinations of the export market in China and all that directly affect what's going on in Europe. Remember, Europe is an export economy, And it's really, really closely tied to what's going on in China. And so that will also sort of mess up any questions of whether or not there's going to be a recession in Europe, or whether or not inflation can go down. Or
this to me feels like this could be one of the worst setups possible, which is you just get this like very stagnant economy where just like it's kind of in recession, kind of not, but then you still have like persistently higher inflation, stagflation, right? It's just that this to me seems like a really horrible outcome as well.
So it's actually funny you should say that, because I think had you asked me that like a year ago, I would have just disagreed with you right off the bat. And I think I'm probably coming around to that view, actually, because we know that growth in Europe is not great, but we just
Canada's flat,
right? And the US slowing, its own right, slowing, but we know inflation is really strong, and in my view, going to stay there. And so, yeah, maybe I think I've come around to your point, because I know that you raised this, a long time ago, and I think I disagreed, and maybe it's time for me to eat some crow here and sort of change my.
I mean, I raised it though, like I raised it very early on, and then I genuinely felt that I'm sure a lot of people did when the BOC and the Fed and everybody raised rates by 400 beeps in a year. Less than a year, that I just figured something would break at that point, and you'd have this sort of deflationary wave like we're used to, right? Like central banks raise rate, something goes boom in the night, you get this sort of financial event, you get a little bit of deflation, and then you're cutting rates and sort of re-stimulating. But yeah, just it for whatever reason hasn't happened yet. And to Keith's point, I know he still views this the hard landing is certainly a fairly probable event, but yeah, it hasn't happened, and so right now we're just kind of muddling along.
Yeah, I mean, and I think it just that's what's going to keep going on. I mean, we know that. I mean, I think China's trying to target 6% for GDP growth. I mean, that number's probably bogus, but they're going to have slower growth. The U.S. is probably going to have slower growth. Remember, the PMIs are the manufacturing PMIs in the 47s. Europe, again, expectations might have improved from horrible to slightly not dead. So yeah, I think that's a really, really interesting. I don't know what happens to bond yields in that scenario. The other thing, I mean, we talk about equities and earnings, we haven't even discussed that, which is the margin story, and it is rolling. I mean, that's getting worse in the US. So we talk about equity markets that are dealing with maybe low valuations, but worsening earnings expectations, falling profit margins, weaker sales. So like it's just volatility. I think it's a situation where I don't think anybody knows. I mean, I don't know. I think I know a couple of things here and there on the margin, perhaps, but it's just a really, really tricky situation.
I always bring it back to like just even what we're seeing in the housing market here, right? Which is like, okay, rates are way up. Sales are obviously weak, but like you've got this weird situation where like new listings are somehow coming in at 20-year lows. Like I thought there was going to be this sort of wave of distressed people. I mean, that's certainly what the market was telling everybody, right? Like all these people that are on their variable rate mortgages, they're going to be forced to sell. These private lenders, people that we're going to have to renew. And it just seems like we don't have the answer yet. We know that stress is obviously building, but just it hasn't materialized into inventory. And so you haven't had a market that's really cleared. I went through a decent sized correction in 12 months, but now, I mean, anecdotally, it's firming up. I mean, it's hard to have a continued price sell off when you have no inventory on the market. And so we're actually seeing, I would argue today, and I've said this multiple times, is that people that are buying houses today, right now, are paying more than they would have paid 3, 4, 5, 6 months ago.
Crazy.
You're paying more today. It is what it is. You were able to negotiate good deals, or better deals, I should say, 4 or 5 months ago. When there was a bit more inventory, sellers felt more motivated or desperate or scared. And right now but it's weird. I was looking at a report from the Ontario mortgage lender. Basically, it's the sort of governance around licensed mortgage brokers in Ontario. And last year, 1 of 10 brokered loans was private. That's crazy.
Is that a lot? Sorry, you have to
It's a lot.
contextualize that for me.
So think about this. Any borrower out there goes to a mortgage broker and says, I need a mortgage loan to buy a new home. 1 in 10 of them essentially were going private financing, which is extremely expensive. And it's typically 1 to max 2-year loans. So anyone that would have taken out a private, let's say at the beginning of last year, you might have got a first private loan at 6%. You're probably coming up for renewal now at 10%. And because those are non-regulated lenders, is they can dictate the terms, right? They can say, well, hey, listen, your house value's dropped by 10-15%, so you got to put in more equity before I even consider renewing you. And so all of a sudden you've got this sort of margin call.
Okay, so that reminds me of a question I'm meaning to ask you, which is, so can you help me understand why Canadian housing stocks, and I'll get into them in a couple, have done so well over the last, let's say, 4 or 5 months? And I'll just remind everybody. So, when I look at equity markets and bond markets, we look at sort of sentiment and technicals, and there's a wide ranging different types of sentiment and technicals. There's the RSI, relative strength index, there's the breadth, there's volume measures, there's investor sentiment measures. There's put call ratios, there's volatility index, et cetera, et cetera. But one of the ones I really like to look at are sort of what I call bellwethers. And it's quite an ephemeral way of looking at the markets, but it's something I really like to look at. So for tech, you might look at Google and Meta and Spotify and the microcap index or PayPal, whatever. And for energy, you might look at Exxon or Shell or whatever. And in Canada, I look at sort of Equitable Group. We've talked about these before: Home Capital Group, Go Easy, Sleep Country, Altus, and Altrium. And so can you help me, as a top-down guy, Steve, can you help me figure out why these housing stocks continue to sort of do really well, even though we know that there's less liquidity, we know that these house prices are under pressure? I mean, do you have an idea on why they're doing so well?
I mean, to be honest, to be blunt, not really. I just think maybe it's markets, front running and getting optimistic and saying, okay, maybe these were oversold and it's not going to be as bad as we thought. Like that to me is the only maybe rational conclusion, because I just think I think the housing market can more in a lot of ways can move on its own. Like, the S&P can be going up, but housing can be kind of muddling along. Yeah. So I just think housing takes a lot. It's like a cruise ship. Like, it just doesn't really turn on a dime. Like, like equity markets can bounce around a couple % on a day, right? So housing is just very slow moving. And, you look at people will list a house at a high price for 4 months before they reduce, and then they reduce it by a tiny bit, and then they reduce again, and they take it off the market. They try a new realtor. And so it takes a long time to sort of figure out price discovery. And so, yeah, I mean, right now, I think it's hard to get price discovery. I think prices arguably for sure would be lower today. They should be lower today, given that mortgage rates are still in the 5s. But again, when you have no inventory, sellers have no competition. They kind of set the price.
And it is unfair for me to use just 6 stocks to sort of triangulate what's going on in the housing market, but I couldn't resist asking you the question.
I don't know. It's hard. I don't know. For me, it's like, would you want to own those in the near term, medium term?
I mean, that's the thing. I think I'm still quite skeptical about what's going on there, but
you've got these levered households that are, tied into the housing market, and with a Bank of Canada that's probably gonna have to hold rates higher than everyone initially anticipated.
There's no cuts being priced in, by the way. Something Keith mentioned, which is something I want to jump in there. But there's all the cuts that have been were priced in 6 months ago. They're basically all gone. It's actually quite amazing how things have changed over the last 6 months.
Yeah. It's I don't know. It's going to be interesting, but I think it's a good place to wrap it up. I think you and I held our own here without the old man. That was
we did okay.
Yeah, we haven't knock on wood, we haven't missed an episode yet.
Yeah, that's right.
We've all been traveling and typically bringing our mics. So thanks for bearing with us today, despite Keith's audio issues and Wi-Fi issues. And
and travel issues.
we're doing our best here. It's a low budget production, but we're working with what we got. So as always, we appreciate your support. If you got any value, appreciate the show, want to leave your support, leave us a 5-star review on Apple or Spotify, and we'll see you next week.